Hello there, this is Matt Peterson here for Eurasia Live. I'm here with Greg Priddy, who is director in our Global Energy and Natural Resources practice. We're going to talk here a little bit about oil prices and OPEC and the factors that control their decision making. So, Greg, welcome to Eurasia Live.
Thank you.
So, I want to start here with OPEC. So, what we've seen in the last couple of days is a fall in the oil prices. And this is a little bit surprising because I think the big picture news about energy markets that people will have heard in the last few months is that OPEC suddenly got its act together at the end of last year and made a decision to cut production and try to increase oil prices. And yet we're seeing prices falling in recent days here. So what is going on here at the big high level?
Well, I think that what they're really looking at is kind of a dilemma with the question of whether they extend the production cuts. So that's a big part of it. And the other bearish factor is what is driving that dilemma, which is just we're seeing a lot more production growth in the U.S. than most people assumed back last fall when they were making the decision on production cuts was going to be the case. And so that's exactly what's creating the dilemma about renewal is it's propping up prices, but not getting as much traction as they thought. And it's also pulling a lot of competing supply out of the ground. And so that raises the question of whether it's even in their interest to continue, which at this point is a very difficult question.
So to pull back here for a second, what happened is that at the end of November, OPEC and Russia, which is not an OPEC member, agreed together to try to halt production, and agreed to cut back production. And as we're going into the summer here, there's a big question about whether or not OPEC and Russia are going to renew this agreement and are going to try to keep production levels down to keep prices high. But what you're saying here is that we're seeing another factor interceding, which is that Russia and OPEC don't control the oil market entirely anymore, right? The U.S. shale producers have a big role to play.
Yeah, I think that the big surprise here, even to most American analysts looking at it closely from this side of the Atlantic, was that it started growing in the third quarter of last year. And so that was earlier at a lower price point and larger volumes than most people expected. And what that really does, not to get too down in the weeds in the economics here, but that moves your supply curve over. And so what people are wrestling with at this point is how much the supply curve is moving. Is it still moving over? And all of these efficiency gains in the industry that have lowered their costs so much. So we've just got more competing supply coming on than we expected this early in the game. Most of us had expected 6 months ago it would be more like now that we would be seeing the numbers start to come up.
So what can we say at a general level about where oil prices are going at the moment?
In the very short term, I'm guarded about that because 2 weeks ago, we had a record speculative net long position that a lot of people are bailing out of right now. There's kind of a stampede, and that's what caused the huge price volatility last week, is a lot of people who thought the OPEC cut renewal was a sure thing are no longer so sure about that. It's become a much more difficult, and clouded decision. But, I think that, going forward, the market is probably going to see kind of a doldrums where we have a gradual recovery trend. I don't think this is a terribly bearish scenario because even if the OPEC cuts are not extended, if you assume that the Saudis and their close partners in the GCC, Gulf Cooperation Council, are not really aggressive about ramping back up to their capacity, they can engineer an outcome which would be very mildly bullish by the end of the year. I think prices are kind of gyrate around in the low 50s and then gradually head up into the second half of the year. But that's slower than the recovery they wanted.
Right. So if you're a U.S. producer at the moment or you're investing in U.S. producers, how do you feel generally about how this scenario has played out? It sounds like actually the folks who have survived the last couple of tough years in the U.S. have come out of this pretty well.
Yeah, most of those companies are much, a year ago there were people arguing that there was going to be a big drop in U.S. supply because of the weak financial position of a lot of these companies that were having trouble servicing their debt. And what happened is they refinanced the debt, they got recapitalized. In many cases, smaller, weaker companies, shareholders agreed to be diluted and they issued new shares. But they found ways to get their balance sheet in order. Some of the original investors, that wasn't a great deal for them. But they found ways to come back and strengthen themselves, and that the industry is in a much stronger position financially than it was a year ago.
Right. On the other side of the coin, you've got the Saudis and the Russians trying to figure out what to do in this market. So we talked a little bit about what's going to happen when this current planned production schedule runs out at the end of the summer, or over the summer. What do we think is going on in Saudi Arabia and other OPEC producers as they start to try to figure out what are they looking at as they try to decide whether they're going to renew these production cuts or whether they're going to abandon them?
Well, it's different for each country, but I think for the Saudis, what they were hoping to engineer was a somewhat steeper price recovery, but still not to levels that would balance their budget, just to levels that would be a bit more comfortable for them. But now you have this dilemma of an external variable that's come on that has raised the question of whether one could do that, whether you could have this stable rise as inventories come down and you get back to the equilibrium sooner. That's almost, the growth has been so astounding in U.S. shale that it's kind of raised the question of whether you can continue that scenario or whether extending it would simply raise prices the second half of this year, but then you've got a huge amount of U.S. production coming on into the first half of next year, given that there's about a 6-month or so delay in the volume response to prices in that market.
Right. So looking elsewhere on the map a little bit, where else around the world are we seeing the potential for politics to intervene in a big way in the oil markets? So, countries I'm thinking of here, maybe, Iran, Libya, Nigeria. How do we see oil production playing out in those places?
Let me address each of those three. Briefly. Libya, we've had a very good call on. Last week, and I won't get into all the backstory here, but you had one militia commander in eastern Libya who retook a couple of oil export ports from a rival group that had taken them 2 weeks before. And understanding all the local politics of that was really important to understanding 150,000 barrels a day of oil one way or the other. But that's very tradable because it influences Brent, because it's a very Brent-like crude, one of the European crude benchmarks. So it's really useful to know those things, and that's one we were right about. Iran, there's been worries about Trump, and the problem that Trump has is that he can't get sanctions to snap back unless there's really an argument that Iran has broken the nuclear deal, which there really isn't at this point. That's still a concern on a longer time frame. Iran has done some provocative things, these missile tests. We're going to see sanctions from the U.S. strengthening, and that's going in a somewhat worrisome direction. But it's not a bullish oil story right now. And Nigeria is mildly bearish at this point, in that the attacks in the Niger Delta that had reduced their production last year have reduced a little bit, and so some of that's getting repaired and brought back on, and so we see that going up slightly into this year. But the major price driver at this point is the OPEC decision. All of those other things are either too small volumes or too long a time frame to be big market movers in the next few months.
So what's the time frame for OPEC here?
Well, the meeting is scheduled for close to the end of May, when they're supposed to decide on extending the cuts. Now that doesn't cover the non-OPEC portion of it, which is mostly Russia. Part of the problem with this, Russia has only done about a third of what they pledged, which may have been because they had a harsh winter and they often have seasonal variations for that reason. But we're looking at a kind of late May decision time frame for what they would do in the second half.
So do you think that, given that we don't really, do we think we have enough information about Russia's behavior here to say that they'll really comply with the deal? Has that assumption actually been
We've been
tested yet?
skeptical, and I think the last week I've become more skeptical on that, partially because Rosneft executives have been out again saying we shouldn't extend this and complaining about it. It was clear, last fall Putin decided that he wanted them to do it, and he decides everything in Russia. But it was not something that the Russian industry thought benefited them or their shareholders. And so Rosneft is out again making the argument that, look, our competitors are bringing supply on, we shouldn't keep doing this. Which doesn't guarantee they don't sign on to it again, but the economic argument for it has been weakened, and I think that's what Rosneft is trying to point out.
All right. Well, we're going to leave it there. Thanks again for joining us. I'm Matt Peterson, speaking here to Greg Priddy from our energy practice. Thanks, everybody, for joining us.